David Burrows is here at Barometer Capital Management. We're talking North American large caps, and I'm all giddy because this is my first time on Market Call with a video question. Claude has written in, or called in, or what do you call it now? Videoed in from Hamilton.
Hi, Mark. Claude from Hamilton again. Want to thank Mr. Burrows for his recommendation last year of NXP which has been with the currency exchange a nice double for me. But my question for Mr. Burrows is Intel. There's been some interesting developments there, I understand, in recent days. And does he think that this is a buy, hold, or sell at this level? Thanks so much. Bye.
Great.
All right.
So Intel plays into a couple of key themes. First of all, we like semiconductors. Second, we like big tech. Not specifically because it's high growth, but because it's big cash flow generator that can have great dividend growth, and we're seeing that out of a lot of technology companies. Intel's big problem has been they're so centric to PC.
Yeah.
And that has been something that's held them back. They are a dominant company, but it's held them back.
So clearly, the first thing they need to do is acquire a server chip
Let's do something a little different. So they've gone out to buy Altera. Altera should help them with networking. It should help them with data centers. It does add a little additional margin to the business. It's a small piece, but it's something that should help them with a piece of their business. What I do think is really interesting is that semiconductor companies are seeing strategic value in paying premiums to market to be able to go forward and they believe be more profitable.
It's a 54% premium to before the rumor hit the tape.
Right. So that means as private investors being able to buy things at market price today when strategic buyers are prepared to pay significant premiums that they believe they're getting good value, right? So look, I think that if I had to choose a semiconductor stock, I'd rather own a Avago or an NXP semiconductor, something tied to the Internet of Things. But Intel's a different animal. It's big cap tech with big cash flow. You get good dividend growth, and it's not quite as aggressive a position. So I think that you make money in this from a total return standpoint with very little risk.
All right. Thank you very much for the video question. You can send yours as well. You can use any of the major social media services. Make sure you tag us on it when you do. Let's now go to Jack in Oakville now. Hi, Jack.
Hello there. Thanks for taking my call.
You bet.
I just like David's opinion, actually, on Apple. And if you could just explain to me why many of the large money managers, because of its market cap, tend to avoid the company. Thank you.
Well, Jack, it's been at their peril. At Barometer, Apple is our single biggest position in the firm. We own it in virtually every account. For some time, they've been in a product cycle upgrade with their iPhone. Interestingly, a lot of the incremental sales in iPhone have not been to existing iPhone purchasers. It's been from other branded products.
Stealing market
share. So they're
share.
taking market share. They've got tremendous growth in China. We were just comparing notes off camera. We're both wearing the Apple Watch.
Yeah.
That's due diligence, right?
That's how I explained it to my wife.
But I have to say I'm inseparable from mine, actually, since I've had it. I look at it, it's an inexpensive company that has such a dominant market share position. The price is doing what it should be doing, given the fact that we think things are improving. Their return on equity in the most recent quarter was an all-time high at 39%. So their return on equity continues to improve. And I think the thing that people misunderstand is that the very most profitable piece of the business is their services business, which is like the fees they get when they sell stuff on iTunes.
They get 30 cents on the dollar.
That's right. They're getting very good returns there. Things like storing things in the cloud, the monthly subscription. That is a business that's only going to grow as they continue to offer more content, like streaming content and so on. So I think that there's lots of upside still in the stock. And the risk reward, I think, is very good. And it's the ultimate consumer company. So look, we always want to have a portfolio of lots of different positions, but I think that it's a $750 billion company. The question obviously is how long can they grow at the rate that they've grown at? They're doing a pretty good job of it. So as long as price is doing what it should be doing and the numbers are supporting valuation and I don't see why you wouldn't want to own this.
All right, thanks, Jack, for joining us from Oakville. Let's go to Hamilton again. Louisa, thanks for holding. Welcome to Market Call.
Hi, thank you very much for taking my call. David, I've really learned a lot from your way of looking at stock markets, and I have been trying to apply it. So I've made a good profit on TELUS some years ago based on your recommendation. And because a lot of the stocks I now own, I want to have dividends or growing dividends as I near my retirement. My dilemma now is, do I keep it, thinking that it won't be harmed as much as some other dividend payers, or is it better to sell it and move into the U.S.?
Right.
I think I know the answer to that question.
That's a tough tactical question. I would say you're probably best served to maybe move on. We still own some TELUS. It's a smallish position for us. I go back to the point I made earlier. You own different things for different periods of time. And you have to understand the environment that you're in. And I think that we are into a world where if rates are going to slowly rise, and I think they'll slowly rise, and if the economy is going to slowly get better, I think that you probably have better total return looking to the U.S. We think that with weak commodity prices, Canadian dollar continues to weaken, so you could probably make some money on the currency exchange as we go forward. I think from a sector perspective, telecom is less attractive. Within the telecom sector, there's no question TELUS is the star. They've had very good dividend growth and will likely continue to have good dividend growth, but you probably can get better total return looking at some of the U.S. consumer names or healthcare names or media companies, frankly.
There's the big three in Canada over the course of the last 5 years, with TELUS, the clear outperformer, Rogers Communications, the country's biggest, as the underperformer amongst the three. But if we look into the United States for a place to play in telecom, do you just buy Verizon and call it a day?
Well, I'm not sure I would go and buy Verizon or telecom in general. As I say, I think there's four obvious sectors, and if you want dividend growth, I would go to the financials. Mm-hmm. I think you could buy Wells Fargo. I think you could buy another name we'll talk about today. You could buy the regional banks, which I think actually are very, very attractive. But you're probably going to do a little better there.
So, Louisa, stay with us. The top pick in the U.S. financial services space is coming up in about 23 minutes' time, even less. We're taking a short break, but when we come back, it's back to David Burrows, the president and chief investment strategist at Barometer, taking your questions on North American large caps. We've got a line open at 1-855-326-6266. And when we come back, we're off to Bracebridge, Ontario.